This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
How do we find the fair value of the subsidiary net assets at date of acquisition for working for the goodwill calculation? How do we do that?
Take from the statement of financial position?
Well, no, because he won't give you the statement of financial position at date of acquisition. What he'll do is he'll tell you what the retained earnings were.
Share capital, retained earnings.
And a share premium, and any other reserves that there may be. He doesn't normally throw in any other reserves. It's normally just share capital and retained earnings will be there, and there's a reasonable chance that share premium will be there, but there's not normally any other reserves there. So fair value of net assets, subsidiary net assets at date of acquisition are share capital, possibly share premium, retained earnings he will give you. But you need to be careful here. You need to be careful because he may say the net assets at date of acquisition were, and it's easy to read that as the retained earnings were. So if he gives you the figure for net assets, that's share capital and share premium and retained earnings all combined. He will give you share capital and share premium separately, so you need to deduct those from the net assets at date of acquisition to find the retained earnings at date of acquisition. So it's a clever little twist that he can put into the exam to see whether you understand that net assets equals all these different elements of shareholders' funds. All right? But there's another thing we need to put in there, Irina. Share capital, premium, retained earnings. There's another adjustment that we may need. What colour is your hair? It's fair, isn't it? It's fair hair. It's a fair colour. So we've also got these fair value adjustments to put in as well. So it's capital, share premium, retained earnings, and any adjustment for fair values, and there will be an adjustment for fair values within the exam question, probably. That gives us then the value, the fair value of the subsidiary net assets, and we know what we have valued it at because we know what the cost of the investment is together with our estimation of what is the value of the NCI investment, so that will give us goodwill. What's the accounting treatment for negative goodwill, Yekaterina? Add. You need to add it to the retained earnings. It's a profit, it's a bargain purchase. What circumstances may give rise to us paying an amount which is lower than the fair value of the net assets? 5 marks, part B of a question. What circumstances may exist in order that we can find ourselves in a bargain purchase situation? And why would a company want to sell its fair valued net assets for less than the fair value of its net assets? Normally you'd expect to pay a premium because you're buying control. But in that question, Robertus and Ingrida, we had a bargain purchase of 6,000. What are the circumstances where the shareholders of Ingrida are quite happy to sell the company for 6,000 less than its fair valued net assets? Anastasia. Poor performance in the subsidiary? No, I think if the subsidiary were poor performing, I think your better option would be to get rid of the directors, which I think is what's happening with BlackBerry at the moment, isn't it? Isn't BlackBerry getting rid of its directors, wanting to get rid of its directors because they're poor performance? I think so. Do you never listen to the news? Is this not something that you do? No, you're always studying, I know. Yeah. So I think your better bet will be to get rid of the directors if the company was performing badly. The situations which may exist whereby shareholders of Ingrida would be prepared to sell for 22,000 a company which is really worth 28,000 would be, for instance, if the shareholders wanted to get out quickly. If maybe a falling market, maybe they only foresee profits, poor profits, or even losses in the future. Maybe they say, well, we need the money. We need the money to pay off the big guys in the blacked out windows Mercedes, dressed in dark suits and dark glasses and no neck and shaved heads, just to escape these people and pay them off. I may need to raise the money quickly, so whatever offer I get for my 28,000 company, I'm prepared to sell it. Or maybe the management stroke shareholders are getting too old. I had a client who was 83 years old, and he didn't have any other shareholders except his wife, who was the same age as him. And if he had sold before he died, which he didn't do, he died first, if he had sold, maybe he would be prepared to accept a lower amount, just to get rid, just to wash his hands of the whole company and say, that's me finished, I want to retire. So a forced sale, where you're forced to make a sale, or where you simply want out. I just no longer want to run the company, make me an offer. That's a ridiculous offer, my assets are worth far more than that. Okay, says the offeror, and walks away. So you say, okay, come back, pay me the 22,000, I'll let you have my company, which is actually worth 28,000. Why not just sell the assets? Well, because there's a lot of hassle selling the assets. Why not just close the company down, sell all the assets and pay off your liabilities? Well, there's a lot of aggravation in selling assets, and don't forget that assets at fair value on a continuing going concern basis are worth rather more than the assets would be on a breakup basis. So rather than reclassify my tangible non-currents into being current assets, rather than continue to recognize long-term liabilities and call them now short-term liabilities, rather than that, I'd rather sell it as a going concern, because at least that way I get a reasonable chance of getting a reasonable price for my company. What if, and in all of these questions there's a fair value adjustment, what if the directors of the selling company don't realize what is the fair value of their assets? The book value, the carrying value of those assets is basically historic cost less accumulated depreciation. Current assets are lower of cost and net realizable value. But what if one of these assets is in a prime location and the directors of the selling company and the shareholders of the selling company are not actually quite aware that there will be a new terminal for the airport which is likely to be built, and the directors of the buying company are suspecting that if there is a new terminal going to be built, the land values are going to increase because they will be compulsorily bought by the airport authority. So if the directors of the buying company are aware that the assets of the subsidiary are worth rather more than the carrying value in the subsidiary's records, then they will put a fair value on it, which is not necessarily what they're going to tell the subsidiary shareholders. There's all sorts of reasons why the fair value of a subsidiary's assets may be rather greater than the carrying value, and where therefore the shareholders of the subsidiary are prepared to sell for carrying value. What if the parent company is buying the subsidiary because of the symbiosis? Do you know the word? What is it in your language? How can you know the English and not know your own language? Symbiositiu or something. Symbiositiu avimos. No? Well, you always put little funny endings on your words. Yeah, the synergy. What about synergy? Are you happy with synergy? What about, therefore, if we acquire the subsidiary, we can use it to supply us with cheaper components? Do you remember I mentioned a motor manufacturer? Why should we not acquire the business or the company which makes the chassis, the framework for the car? Why should we not buy the company which makes the seats for the car? So if there is a good synergy, a good symbiosis of a commercial sense to buy a company because it fits nicely into our existing operations, then we will probably value, on a fair value basis, the subsidiary assets at greater than the carrying value. What if they have a raw material, a commodity, which we need and is rapidly becoming in shorter and shorter supply, but we know that this company has a good stock of it? Then the stock of that raw material, coal or oil or tin or gold or something which is mined out of the earth, sand even. What if we've done a geological survey on their property and we've decided that their natural resource hidden underneath the surface of the land is worth a lot of money to us, and they possibly have not realised it? We will put a fair value on that land, rather more than the carrying value is. So that's how it can happen, that we pay less than the fair value of the net assets at the date of acquisition. Those are the possible ways in which we can find that negative goodwill arises on the acquisition. What's the basis of the calculation of working 3, Renata? What was working 3, Ekaterina? Consolidate. And what's the basis? Do you want to sing it to me? Sing me that song. H is on plus. Go on, rap it. Rap it. H is own plus H's share of S post-ac retained less goodwill impaired since acquisition. Less goodwill impaired since acquisition. H is own plus H's share of S post-ac retained less goodwill impaired since acquisition. Yeah? Sing it to yourselves. I'll sing it and you sing it with me quietly. All right? Go through it as I'm saying it. H is own plus H's share of S post-acquisition retained less goodwill impaired since acquisition. It's a good, yeah, it's a good. So there are songs, there are now discos where the DJ will play the accountant's records. Another favourite accountant's record is TNCA. TNCA. Do you not do the TNCA dance? Do you not do that? What do, you people? It beats me, it defeats me. How can you live your life without knowing the TNCA song? What's the basis of the calculation of working 4? I've forgotten what working 4 is. What's working 4? You escaped the last question, Renata. What's working 4? It is the non-controlling. What's the basis of the calculation of the non-controlling interest? It's the value at the date of acquisition plus their share of S post-ac retained less minus their share of goodwill impairment. But there won't be minus their share of goodwill impairment if the NCI was originally valued on what basis, Ginter? On a proportional basis. There will not be any goodwill impairment to set off against the NCI. Yes. Are we on page 45? Yeah? Page 45, fair values of assets and liabilities acquired. Securities and tangible non-currents are valued at market value. Receivables and payables at present value. You need to be well on top of discounting and the principles of discounting. Somewhere in the exam there will probably be a discounting calculation to do. What's the value of 2 million in 2 years' time if cost of capital is 10%? I have to pay 2 million out in 2 years' time. What's the present value of that 2 million in 2 years' time? Basically, how much should I invest today, earning 10% interest, in order that I have 2 million in 2 years' time? 1 million? 1,600,000? No. No, not 1,800,000 either. Put in your calculators. Put in your calculators 2 million. Multiply by 1. I don't expect you to do that on your calculator. All right, some of you want to do multiply by 1 equals. Now, divide by 1 plus the rate of interest. Rate of interest is 10%, so 1 plus 10% is 1.1. So divide 2 million by 1.1. That gives me a figure, I think, of 181818, doesn't it? Yeah? If I invest 181818 now, then in 1 year's time I will have 2 million at 10%. Divide 181818 by 1.1 again. That gives me 1650 something, doesn't it? Yeah. 1650 invested today at 10%, cumulative. Multiply 1650, the figure you've got now, multiply that by 1 plus 10%. That's going to give me 1818. Multiply by 1 plus 10% again. That gives me 2 million. So discounting is bringing a future value of money back into today's terms. And it's done by dividing by 1 plus the rate of interest. Rate of interest is 10%, so I'm going to divide by 1.10. For as many years into the future as this obligation lies. Are you clear on that, Renata? Are you clear? Everyone clear? Anyone not clear? Is Lena clear?
Hopefully.
Well, she's got a blank look on her face. Future value divided by 1 plus the rate of interest as many times as is necessary. However many years into the future that obligation lies, bring it back, 4 years, and that gives you the present value of the future obligation. Receivables and payables, present value. Finished goods and work in progress is net selling price less a reasonable profit margin. Raw materials, replacement cost. Intangibles by reference to an active market or otherwise on an arm's length basis. Brands, patents, royalties, software, customer lists. On an active market, if there isn't an active market, then on an arm's length basis. What's an arm's length basis? What's an arm's length basis? That's an arm's length basis. A willing buyer and a willing seller. How much am I prepared to sell for? How much are you prepared to pay me? That's an arm's length basis. It's based on the handshake at arm's length. I'm not going to, excuse me a minute, just while I hug into, no, that's too close. That's a bit too close, isn't it? So it's an arm's length basis, shaking hands on the deal. If the fair value of an intangible cannot be measured with respect to an active market, then the amount that we recognise should be limited to an amount that neither creates negative goodwill, or if negative goodwill already exists, it doesn't increase negative goodwill. I don't think I've ever seen that in an exam question. The method: adjust assets and liabilities to reflect fair values before consolidation, and then prepare the consolidated financial statements using those adjusted values of assets and liabilities, and think if any adjustments may be necessary, for instance, additional depreciation expense. We've got on page 46 an example which includes this additional depreciation expense. Down at the bottom of the question, which is where your eyes should immediately have gone, when you read a question, always read the requirement. Always read that first, so that you know what it is you're meant to be doing. Down the bottom of the question, it says it's Dahlia's policy to value the NCI on a proportionate basis. So there's no goodwill impairment, but if there were a goodwill, they weren't going to get any. Right at the bottom of the question, prepare the consolidated statement of Dahlia's, and goodwill, we are told, is not impaired. Working one you can do. You notice we bought on the first day of the accounting period, so there's no time apportionment. There's no time apportionment involved. Working 2. Cost. I'm not going to keep writing cost of investment. I don't know whether you want to. Maybe to remind yourselves of what I mean by cost, it's the cost of the investment that Dalius has spent buying 70% of Ramuna. The cost, it does actually say on the top line, doesn't it? Dalius acquired for $250,000, but it may not do. It may not actually say that. So just mentally strike through that figure of $250,000. It's not there. That figure of $250,000 on the top line of the question is not there. How do I know what the cost of the investment is? It's in Dalius's statement of financial position. Look, it says cost of investment in Ramuna, $250,000. It's there within the balance sheet of Dalius. Cost $250,000. There is a value attributable to the NCI, but I don't know what it is, because they're proportionate on the basis of their share of the fair value of the subsidiary net assets. And I don't know what the fair value of the subsidiary net assets is. Fair value of subsidiary net assets at date of acquisition. Shares, 130. Retained earnings, 20. That's the book value. That was basically the balance sheet of Ramuna at date of acquisition. Share capital 130, retained earnings 20, net assets 150. But now we're told in the next paragraph, at acquisition the fair value of some of those assets was greater than their book values. You can do it in one figure. I'm not going to, because that way lies problems. I've got a fair value of inventory adjustment. This is 20,000 more than the book value. Non-depreciable, non-current assets, they're 15,000 more than their book value. Depreciable non-current assets, they're 30,000 more. So really the balance sheet, instead of showing 150, the balance sheet should be showing 215. That's the fair value of the subsidiary net assets at date of acquisition. And the NCI want 30% of that, which is 64,500. So the value of the company is 314,500. The fair value of the net assets is 215. Goodwill is therefore 99,500. And it's not impaired. A question in the exam, this question doesn't, we can assume it, but a question in the exam, I just turn to a consolidation question at random, question 44 in the BPP revision kit. It will normally say, and it does in this one, the fair values have not been reflected in the subsidiary's financial statements. The fair values have not been written in to the subsidiary's financial statements. This is normally the case. The fair value adjustment is only for the purpose of determining goodwill. It does have a further impact on us, but that's the only reason why we're looking at fair values, is so that we can get a proper goodwill figure. So most of these questions will actually spell out the fact that the fair values have not been reflected in the subsidiary's records. So in this question that we have Dalius and Ramuna, the Ramuna balance sheet does not reflect the fair value increases that we acknowledged at date of acquisition. Working 3. Now I'm naughty here, I'm very naughty, because these fair value adjustments really should go through a revaluation reserve, and I don't do that. I put them into the retained earnings, and I'm naughty in doing that. It doesn't matter to me whether it's a retained earning or a revaluation reserve. And if I'm getting that close to worrying about it, then I'm also getting that close to trying to win the global prize. And I think if we're realistic about this, I don't think any of us are aiming for the global prize, are we? Does any one of you anticipate coming top in the world? Does anyone have hopes, aspirations? No? Then it doesn't matter to me whether you put it into retained earnings or into a revaluation reserve. Strictly it should go into revaluation, but I'm not. I've got Dalius and Ramuna, per the question, retained earnings 360 and 100. But you know that 100 does not reflect the fair value adjustments. That 100 is part of capital employed in Ramuna, and we moved the capital employed up here. We said, no, there's this additional elements in capital employed, this fair value adjustments. This was at date of acquisition. This working here is now. These assets that were fair value adjusted at date of acquisition, on the assumption that the non-depreciable and the depreciable are still in Ramuna's possession. The inventory hopefully won't be. The inventory will have gone, because it's some time since we made the acquisition, and hopefully Ramuna has sold the inventory. A question will make it clear. This one doesn't make it clear. The situation now is, that's what the retained earnings are now, but what about these non-depreciable and depreciable non-current assets? The non-depreciable non-current assets have got a fair value adjustment. We've still got these assets. They may have changed in value. They may have, it was a 15,000 increase. Maybe it's actually 20,000 now. Maybe it's only 10,000. We've impaired them. The only thing I can assume in this question is that we still have those assets and they're still worth 15,000 more. But the depreciable non-current assets, although we still have them, it's been a while since we bought the subsidiary, and therefore they will have been depreciated, or they would have been depreciated if we had reflected these fair values. How much is the fair value adjustment for these depreciable non-current assets? We bought in 2008, we're consolidating in 2009. These assets are being depreciated over 5 years. What is the fair value adjustment in respect of this 30,000 depreciable non-current assets? How much are they worth today? Say again? We should take depreciation into account. Yeah, we should. This fair value adjustment of 30,000. If we had written it into the records, then we would have depreciated. So how much is this 30,000 now worth if we had depreciated? Lena? 18. There is a temptation to say 24. I know none of you was tempted. But we actually bought on the 1st of January 08, and we're now consolidating at the 31st December 09, which is 2 years. So these assets today have a fair value adjustment of 18. $133 is the value of the fair value of the assets today, of the retained earnings today. If I take off the pre-acts, that will tell me how much of those retained earnings have been made post-act. And I can do the pre-act by looking again at working 2. What's the value of these assets at date of acquisition? The pre-acquisition value of these assets. It's there in working 2. Tell me again. 85. Retained earnings plus the fair value adjustments. $85. So pre-acquisition retained earnings were 85. Therefore post-ac must be 48. And our share of those post-acquisition retained, our share is 70%. 33,600. H's own plus H's share of S post-ac retained is therefore 393,600. Less goodwill impaired since acquisition, but there hasn't been any. Goodwill is not impaired. So the figure for retained earnings on the balance sheet, 393,600. Working for the NCI, 30%. Value at date of acquisition, we did work it out, 64.5, wasn't it? Yep, 64,500. Share of post-ac retained. It's 30% of the figure we've just looked at. Here, 30% of that figure, 48. Which is, I think, is 14,400. Less their share of any goodwill impairment, but there isn't any in this example. $88,009. Consolidated statement of financial position. ACCA 99,005. Other assets. According to the question, that's 350 plus 300. But these other assets have been fair value adjusted. I still have 15's worth of non-depreciable non-currents, and I still have 18,000's worth of depreciable non-currents. 683. $782,500. Shares. What are those three words that I'm not going to say again? Vita, what are those three words I'm not going to say again? Always, only, ever, H. Just the share capital of the parent company. No share premium. We do have retained earnings. That's in working 3. And always will be 393,600. We've got the NCI because they're also providing finance. That's working 4, 88,009. That's 682,005. 682,005. Oh dear. Have I added that previous one up right? Say again? NCI is what? 78. Have I added that up wrong? Yes, thank you. 78,900. Thank you. You could have told me earlier. Liabilities, 40 and 70. Did you, I don't know whether you noticed it or not, but when I added the 40 and the 70 in my head, I got to 110, I realised it should have been 100. I knew I'd made a mistake for 10,000. The obvious mistake, if it's 10,000 or 1,000 or 100 or 10 or 1, the obvious mistake is an addition mistake. So if it's 1, 10, 100, 1,000, 10,000, if it's just one wrong in the addition column, it's an addition mistake. If it's just a single unit, whatever the value, 1 million, 100 million, 1,000 million, if it's one wrong, it's an addition mistake, probably. That's what I said. Have I added something up wrong? If I had been 24,000 wrong, if I'd been 24,000 wrong, it's because I've treated that incorrectly, the depreciable non-current assets. I would have added the depreciation onto the 30. I would have had 54 there, and that would have given me a difference, I think, wouldn't it, of 24. 12. I wouldn't have had 54, I would have had 42. That would have accounted for a difference of 24. So take the difference, divide by 2, and see if I've got an adjustment the wrong way round. I've added it instead of subtracting it. Another one, if it had been 18 wrong, it's because I've missed that adjustment. If I'm exactly at 18 wrong, and 18 appears somewhere within the question or the workings, then it's likely that I've missed it off completely. If the difference divides by 9 to an exact figure, then it's because I've picked up 683 and I've written it down as 638. I've made a transposition error. That transposition error is a difference of 45, and 45 divides exactly by 9. So if the difference divides exactly by 9, it could easily be a transposition error. You're not likely, in the exam situation, you're not likely to have time to go looking for mistakes. If you do, then those are easy ways to see mistakes. Look for the exact figure. Take the difference and divide by 2. Take the difference and divide by 9. If it's 1, 10, 100, etc., it's an addition mistake. Those are ways of finding errors. But you probably won't have time in the exam because you only have 45 minutes. Okay, that's, who was that? That was Dalius and Ramuna.